Welcome to the Transparent FX Academy. I'm Nick and I'm a top plotter in TradingView with over 190k reputation points. And in this video, we will try to understand where we have the highest probabilities for a potential move on this pair. Now, how will I be doing that? As usual, first I will be analyzing the pair from a technical perspective, then we will go and see what we have when it comes to the order flow, so the commitment of traders, which is what hedge funds and the non-commercials, so the biggest speculators in the market, are doing. So without wasting any more time, let's jump straight to the charts. In today's video, I want to speak about gold because at the moment we do have quite interesting price action and structure. So let's get straight into it. Now, starting here on the monthly time frame, what we can see is that at the moment the market is testing a very strong level of previous monthly resistance here. Again, resistance here and again resistance here, which the market broke to the upside with this impulse. And at that point, all this previous resistance was turned support and demand here. And as we are testing this previous resistance turn support, we could expect the market to reject the level to the upside. We can also notice how the market has now created an impulse and correction. And in general, if you want to measure the correction after an impulse, what you have to do is take your Fibonacci from the low to the high of the impulse. And if we do that, we can see in fact how the 0.786 Fibonacci retracement, which is the last Fibonacci level to which you expect the market to retrace to, is currently lining up perfectly with this previous resistance turn support, creating a very strong layer of support and demand here that we do expect the market to reject to the upside. Now, if we drop down on the weekly time frame, what do we see? Now here in the weekly, we can see how the market at the moment just created a very strong impulse to the downside, followed by the start of this correction. Now, in general, if you have an impulse, as we said previously, and we want to measure the correction, what we have to do is take our Fibonacci from the high to the low of the impulse. And if we do that, we can see how we have the 0.32 Fibonacci retracement, which is currently lining up exactly here. And the market is very near to testing this level, and after a test we could definitely expect a potential rejection lower. Before then, printing the continuation to the upside that we already would like to see by looking at the monthly time frame. So far, by looking at the monthly and weekly, we could expect more continuation to the upside from a monthly perspective, but looking at the weekly time frame, we could expect some short-term bearish price action. So we could expect short-term bearish price action and then longer-term continuation to the upside. Now let's take more information. Let's go also down on the daily time frame and see what we have on the daily. Now from a daily perspective, we can immediately see that at the moment we do have interesting price action on the daily. In fact, we can see how in creating this move to the upside, the market also printed this W formation. And in general, after the creation of a W, what we want to see is the market create a move to the downside to go and complete the pattern at the previous resistance turn support, and then create the continuation to the upside, which is aligning perfectly with what we have already seen on the monthly and weekly, because this pattern suggests the possibility of having short-term bearish price action and then longer-term bullish price action, in which the short-term daily price action, which is supposed to be bearish, is lining up with our view on the weekly time frame, while the continuation to the upside is lining up with our view from a monthly perspective. Now, if we go and see what we have when it comes to the commitment of traders, which is the COT data, so what the non-commercials, so the biggest speculators in the market are doing, and we check the data for gold, what we can see here is that we went from having 254k net positions down to having 175k net positions, with 12k shorts added with the last report alone and 5.9k longs getting closed, reaching 107k short positions from the 70k that we had here, and decreasing the long positions from 365k to 283k. So gold definitely has the possibility of being bearish in the short term with this rejection to the downside based also on what we have just seen that we have from an institutional perspective by looking at the COT data. So taking the situation here one at a time, how we could be looking for this potential short-term move to the downside and completion of the pattern at the neckline. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily combined with the COT data, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. Therefore, what we could be doing is monitoring price action from an intraday perspective during this move to the upside, waiting for the market to shift from an intraday bullish market as we have right now to an intraday bearish market. And if the market would shift from an intraday bullish to bearish market and provide to us one of our valid entries, at that point, we could be looking for this potential move to the downside and completion of the pattern at the neckline. Now, if you don't know what I'm speaking about when I say market environment shift and valid entries, that is all part of the mentorship program, which you can access now completely for free. The link, in fact, is in the description, and I really suggest that you go and check it out. Now, if you enjoyed this video, make sure you smash that like button and comment below. It really does support the creation of more free education analysis for all of you, because obviously it helps with the YouTube algorithm, and I will see you in my next video.